Welcome to the daily update, where I'll go over the action in the market for Monday, March 18th, and then we'll see how things look for Tuesday, March 19th. We had an up day, but it wasn't necessarily a real positive day. Of course, price is the ultimate indicator, and we have to go with that. And we did see the S&P go back up, but we hit our high early in the session and then closed kind of at the low if you take just the bars within the day itself. And we're still shifting a little bit more negative when we look at our different charts. So weakness is starting to creep in, but we're still above that long-term either resistance level. And the more we stay above it, it may end up being support level. That's on the weekly chart between 51.10 and 51.11. The markets are really in wait and see mode now. They're really anticipating the FOMC meeting on Wednesday. Not so much what they're going to do, but the press conference that will come after that when Chairperson Powell will give his press conference. And we're going through this shift in the scenario where the market thought, okay, everything's under control. They're going to lower interest rates and everything looks at least good in that aspect. And then last week we had CPI and PPI come in hot. That's thrown some real confusion into the scenario. And so they're going to be looking to see what the Fed does. And this is a real shift. You go back 10, 20, 30 years ago when I first started in this, and it was always the Fed that was following the market. Now we've shifted over to where the market follows the Fed. And whether you agree or disagree with that, it's the way things have evolved. And it's just kind of the shift that we've seen in culture, but then also in the financial area as well. So one thing to get away or to go through before I go into the video is I posted a video. It's 20, 25 minutes long, something like that, talking about the program that I have. And I didn't go into a lot of detail. I just kind of want to post these videos periodically, maybe once a week, every couple of weeks. I plan on starting the program in June. That's a target date. That's not an absolute date. I'm years behind where I wanted to be with this, and for a lot of different reasons, mainly because I spend so much time each day doing these videos. By the time I get working on the other stuff, I'm wiped out. So I'm trying to use a little bit more energy to actually work on the program. But feel free to check that out if that's something that interests you. It's a membership program where there's a lot more involved than just these daily videos. Also, of course, we have to have our Perma Bear declaration. This is somebody that I've been following for over 20 years. No matter what happens in the market, there's always doom and gloom right around the corner. This is a quote from an email that was sent out, and it just says the stock market is now issuing a warning to all investors as a dangerous development is occurring right now. The imminent conclusion of huge multi-decade bearish rising wedge patterns. This person's been saying this for going on 20 years. Okay, so, and it might happen. I mean, if they say the same thing over and over and over, eventually they'll be right, and then they'll congratulate themselves for what insight they had. But we're near all-time highs. There's a lot of really positive things that are in the backdrop. We're still longer term positive. We might be going through some kind of weakness, but that's what we'll do is if we start to see things go down, we'll evaluate things both in the short term and then in the longer term, and then say, okay, is the climate shifting? Because there's a lot of positive things back there, and the market's had a really good run up, and there's going to be a time when folks are going to want to take some profits. And we are seeing some weakness coming in right now, but we see more of an upward move, and that could get taken care of. Also, another thing that might scare you to death if you are involved in NVIDIA, Jim Cramer, if you know who he is, okay. If you don't know who he is, count yourself fortunate. But he says that NVIDIA will create the next industrial revolution. He's been notoriously wrong, okay? And that's got a lot of people scared right now. So, all right. All right, let's go back and talk about what happened. Right at the open, we had a gap higher open. There's been some positive news out of Japan, or at least that's what was pushing futures prices up during the night, um, going into the open. And then that just fed over into the cash session. It kept staying positive as Europe opened, but there was a gap higher open above R2 at 51.52. We're dealing with that crazy Van Halen level, the 51.50. We closed right at about there. And prices hit resistance. We hit it at a round number at 51.75. That was the high for the day. Remember, it's the amateurs who open the market, and they really push things higher. There was a lot of backlog of orders over the weekend to buy things at the open on Monday, and that's when things started to go up. Unfortunately, we then drifted lower after all that opening stuff got done with. We went back down to S2 and we closed below S2, just below that crazy 51.50 level. But we were still up 0.63%. That's almost the same percentage that we were down in Friday's session. We were below average with volume. We had another up day and a decrease in volume. We are positive with our technicals, but we're looking a little vulnerable, at least in the short term. And then, like I said, if we do start to pull back, we'll evaluate that day by day by day to see if it's gaining in a momentum and it's going to turn more negative. And even though it's about inflation and interest rates, that's going to be pretty much led by what Jerome Powell says at the press conference and how the market interprets that. Some comments. The Bank of Japan has hiked rates for the first time in 17 years, and they've also abolished their yield curve control. So this is just seen as, okay, some more of the free market principles are coming back in and taking over instead of the government controlling everything. From what I could tell, the rumors about this happening are what helped the futures. Now it's actually come out. I just found this right before I started recording, and this is after the market closed. Mega caps had a pretty good day, and Google had a good day, and I have that chart to show you later on. But the small caps were down, and even when we were up strong right after the open, we still had small caps and mid caps negative. So they're just not showing an awful lot of life right now. We're still seeing interest rates going up. Now, that might have put some pressure on the gains that we saw in stocks, but at some point, the market's going to come in and say, "Wait a minute, we don't like the interest rates where they're at. We're gonna freak out about this." Well, it didn't happen that much in Monday's session. We're still looking extreme with our stochastics, and then in the intermediate term, we have a little bit longer list. Our PMOs, now they're shifting a little bit more negative. Even with the up day, we're starting to drop below the moving averages, but the oscillators are still giving us extreme positive readings. The bullish percent index, even with the update, it did decline. It's still above 70, so it's extreme positive. The Sean trend meter did come down slightly, not quite as extreme as it was before, but still extreme. And then this is our longer 10-period new high, new low study. That's still camped out in extreme positive territory. We're still looking extreme with our 150 and 200-period simple moving averages. And this is the scenario that the Fed might be done raising rates. Now, that might change this week if Jerome Powell comes in with some kind of a statement that the market interprets saying, well, they might go back to raising rates, or they're going to keep rates where they're at right now for longer. That's what the market is going to be waiting to see, is how does this scenario need to be adjusted? We were up to 4.34% with the 10-year yield. That's really it's been gaining lately, and that's causing some concerns. We still have our yield curves that remain inverted, and the CNN money thing's been kind of crazy lately. I had it at 72. They had the previous close at 71. With the up day, we ticked up to 72. We're ticking back up now with the up day, but we're still below that 75 level that gives us an extreme positive reading. We haven't really seen a change here with our ADX. We're positive. The green line's on top. It did turn back up, but we're still dropping below the moving average, and that's showing that there's a weakening trend, but we're still above 20, suggesting that we are in a trending environment. I should have changed this. The bias is positive with the up day. And momentum, mixed to negative, mixed. I would just say mixed right now. I forgot to update this part of the slide. Okay, the economic reports that came out, we just had the NAHB Housing Market Index. It came in at 51. They expected it to be in at 49. Last time it came in at 48. Here is a chart showing that we're seeing kind of, a little bit of an improvement here since November, a bit of an increase, and that is usually good for the economy. But with interest rates going back up, that may put some pressure on the housing market. Here's some Isabel Net blog charts. And if you hear a cat in the background, he's just wanting to say hello. I keep telling him he should do his own videos, but he wants to just jump into mine. This is the valuation of the largest TMT, and that's tech, media, and telecom. The three stronger areas or sectors that we've seen in the stock market. And they look at it today, and it pales in comparison to when we saw it back in the tech bubble. There's a lot of comparisons going on right now with what we're seeing right now is exactly what we saw back in the year 2000. Well, yeah, you can put some things together to make that conclusion, but there's also a lot of things that show that we're different right now. I want to be aware of that and respect what happened, because I went through that whole .com thing and saw people just get wiped out. This was about the time, it was actually about a year before this, when I decided to switch over to just the S&P 500 and focus on up, down, sideways type of strategies. And there were these seminars and programs that you can get involved in where people were just taught enough to be dangerous, and they thought, oh, the stock market's just a big cash machine and we can do whatever we want. And I kind of talk about this in my class, that when you have people that aren't trained in this and aren't experienced in this, when they're bragging about their Cisco stock or their Dell stock or their Enron stock or what have you, but they don't really know what they're talking about, and I think it's just automatically going to happen. That's when I started to get nervous. And that's why I decided to switch over and just look at the indexes. And I go into more of that in my class. But anyway, looking at this on a valuation basis, we're high. When you just look at this, we're at 43 times earnings. Okay, that's pretty astronomical. But we were at 52 times earnings when you look at these same groups of stocks back in the year 2000. And then when you look at the forward PE here with the blue line, this is just showing that we're at 28 times earnings. And this is the median forward PE ratio here. So yeah, you can suggest that maybe we're overvalued, but we're also seeing earnings looking out into the future that are being increased as well. And that justifies these higher PE ratios. Then this is the next 12 months earnings per share. These continue to go up. You look at the total return over here on the S&P, that's going up, and you see the earnings per share, that's going up. That's why we see these higher PE ratios. And then the financial conditions, when things are getting tighter, which is what we started to see as rates were going up, that's when this chart goes up. Now we're seeing a lessening of that right now, and so the money's a little easier to get. The conditions aren't quite as stringent as they were before, and that tends to put liquidity into the economy, which helps the economy grow. Didn't see really anything on Twitter over the weekend. So here is the chart. And yeah, it's positive, but when you just take the action on Monday, that's not very positive at all. We actually closed lower than the open. Even though we gapped higher, we got above S2, we hit resistance right at this 51.75 level, and then we just drifted down, and we closed at the low for the day. So it's not a really good looking chart, even though it is positive. Here's the intraday, where we were pretty much flat, and this is when things closed on Friday, and then right when we started to open Sunday afternoon or evening, depending on where you're located, we saw them really spike up. And from what I could tell, this was the news coming out of Japan, and then we just kept going up and up and up in the pre-market session. That led to the positive open. Then once we hit the high, we drifted lower, and we were coming down just a little bit. We're slightly negative in the initial overnight session. Growth of value. We are seeing the blue line on top of the red line. So that's showing a little bit of an improvement on an intraday basis. And we immediately skyrocketed up with the growth to value ratio for the S&P, but then drifted down from that. And we're kind of in a range right now, more of a short-term range. And we'll see if we're going to break to the upside and show more strength, or is this going to fall to the downside? Here's our end of day chart where growth was up and value was up, but growth was up more for the large caps. It was up less for the mid caps, and it was also up less for down less for the mid caps and down less for the small caps. And so we are falling off a little bit when we look at small cap growth to value, but we did spike up here and we've been hanging on to these gains. Even though we've been showing some weakness, the index is just not doing very well right now. We ticked up a little bit with mid-cap growth to mid-cap value, but this is in a more sustained uptrend. And if you could pick the right areas of the mid-caps, that's been a really good performing area. Not so much the small caps. And of course, we know about the large caps with the Magnificent Seven, but there's been some real pockets of strength in the mid-caps. And then we look at S&P growth to value. It did tick up a little bit. We are still in an uptrend. It would be nice if we saw this ratio continue to go up. That would show more strength. If we see this really coming down, that might suggest some weakness. And then we're looking at discretionary to staples, and I actually made a mistake over the weekend. I said this is a death cross. When we look at the staples equal weight ETF, this is actually a golden cross. We're seeing the blue line going above the 200 period moving average. So that is actually showing more of an uptrend. We're also in an uptrend when we just look at discretionary, and we're coming down to the moving average when we look at the ratio between the two. This is another disappointing area. We are in an uptrend, but we want to see this really going up if we're going to remain more positive. And then here's our trend. We're still below the moving average, and the ADX and the moving average are drifting lower, but we're still positive because the green line's on top and it turned up, and we're above 20. So we are still in a trending environment. Here's the short term, also below the moving average. The green line's going back up, shows that we are still trending. We did really drop off with volume. We were below average. Of course, it was quadruple witching on Friday where we just saw massive volume, so it couldn't help but drop off. But we still dropped below the moving average. Looking at sentiment, this is a weekly chart that we look at. They still have us as extreme positive when you take all these different areas together. And when it gets a real high reading like this is when we at least entertain the idea of using this as a contrarian indicator. And we use lots of those. We have the Ridex bullish bear ratio. When that gets too extreme, we can follow it while it's moving in that direction. But when all the folks are thinking one way, then that's when we start to consider looking in the opposite way. And here's the insider transaction ratio, which actually came down a little bit, and we're more in neutral. And if you can hear the cat, he's just singing a little song for you. This will be updated probably in Tuesday's session, where we're still getting extreme when we look at investors' intelligence. Of course, some people think that's an oxymoron. Anyway, the VIX, we were down a little bit with the line chart. We were also came down just a little bit with the bar chart. But as I've been trying to point out, we're seeing a series of higher lows here going back to about the beginning of December. That just means there's a little more fear slowly creeping into the market as the VIX has been shifting, at least on a short-term basis, to a little bit higher range. And here is the VIX of the VIX. Since we had the update, we saw a drop with the bar chart as well as the line chart. The MACD is still right on top of its moving average, so we don't really know if this is trending higher or lower currently. The equity put call ratio really declined in Monday's session. So we went from going up after Friday to now we're going back down, which is more positive when we look at the 5-period moving average of the equity put call ratio. Here's the volatility risk premium. We're coming back up into the range. We're pretty much flat right now, not suggesting that there's a lot of complacency or a lot of fear. What we look for on this chart is when we go above this range here or we drop below it. Advanced decline line studies. We ticked back up with the advanced decline line based on price and volume, and these have been holding up better. We saw a couple of down days there, but we're still well above the moving averages. And the new highs, we're flatlining. We're kind of getting as high as this indicator can go, and that's why we're going sideways. We are dropping off with the new highs, but we're not really seeing any kind of an expansion of new lows, but our 10 period is still going down. We're still looking okay here with our advanced decline ratio, and you can suggest that we're making a series of higher lows as volume has been improving. This is a warning sign, though. We had an up day, and the accumulation distribution declined, and we're coming back down to the moving average, and this is trying to measure what the smart money is doing. We're also declining, but still positive with the Chaikin money flow, another smart money indicator. And we're actually dropping below the midpoint now with the Chaikin oscillator. So, and this is another smart money indicator, something to be aware of here. When we look at our advanced decline line studies, we turned down just a little bit with the NYSE. We were up slightly with the S&P. We declined with the mid caps, and we're dropping back down to the moving average with the small caps, showing that it's more the large caps that are really showing our strength right now. Here's the daily chart, and I tried to cut it down a little bit since we were getting kind of messy up here in the corner. We're range bound. We have a pivot point above, which is acting as overhead resistance. If we drop down here, we might find some support at a previous price level or down at this other pivot level down below. Then when we look at the volume, we really dropped off from Friday, and the blue line is the moving average, and we dropped below that. We're still above the 20-period simple and exponential moving average, and that so far is holding. We got close to it in Friday's session, but with the gap higher, that means that we're a little further away, so that's still a support level that we'll be watching. We turned back up with our 20, 50, and 200-period moving average study, and not necessarily extreme. We showed some improvement with the force index, but we're still slightly negative. We're no longer extreme in the short term or intermediate short term. We're still extreme positive in the long short term with our stochastics. We're not extreme. We're right on the border between the +1 and the +2 channel, suggesting that we've slowed down enough so we're not going up or down too far too fast. The balance of power ticked down a little bit, but it's still above 0. We're still looking with a little more neutral now with the lighter shade of blue with the go, no-go system. We're still above the midpoint with the highest high value. We're still looking a little more negative with the dark blue TTM squeeze bar. We turn back up with the ease of movement, and we're still above 0. We're flatlining now with the Arun, so no real change there. We're still below 0, but we did turn back up with the S&P McClellan oscillator. So when we look at the summation index, because we're below 0 with the McClellan oscillator, that means we're going down with the summation index, both based on price and volume. Then we're also below 0 with the NYSE McClellan oscillator, so we're starting to turn down based on price and volume. We're dropping slightly below 0 here with the Swenlin trading oscillator based on price. We've already dropped below 0 based on volume, and that's also more negative. So even with the update, you can see the charts are still showing us some weakness. We're rolling over and dropping below the moving average with our PMO, but we're still getting a very high reading. We're starting to drop below the moving average based on price, and we're not quite crossing yet based on volume. We saw a bit of a turn up with the PMOs that are rising. We're declining with the buy signals, and we're starting to decline with the PMOs that are above 0 after giving us an extreme reading. We've gone from being negative after Friday over to neutral with the Elder's Impulse system for the S&P, and this, to me, is kind of a big one. The parabolic SAR for right now is still positive with the dots underneath. The slope oscillator starting to decline and dropping below its moving average after giving us more of an extreme reading. We're also seeing these longer-term negative divergences. We're also dropping down with the MACD. Also, you can make a case for a negative divergence. So we're seeing a little more follow-through weakness here with all of our oscillators on all the different time frames, short, intermediate, and long-term. We're still above the moving averages, though, with our moving average tree. And we did decline with the bullish percent index, but we're still above 70. When this is going up, that has more of a positive slant when we're in this 70 area. Now that we're going down, but still above 70, that could be a bit more negative. Even though we had an up day, to see this go down, that's not a real good sign. We did tick down just a little bit with the NYSE bullish percent index, but we're still above 50. This is somewhat encouraging. Google had a really good day, and that helped the bullish percent index for the NASDAQ 100 to cross back above 50 after it had dropped below 50. So this is showing some improvement. But when you compare it to the S&P, as it's been going up, we've been seeing the NASDAQ 100 bullish percent index also negatively diverge. Even though these are two different indexes, they're closely related to each other. The money flow was able to come back above 50 and turning back positive. The ultimate oscillator is declining, but still above 50. We did turn up with the vortex, but we're still seeing this real weakness here with the green line for right now. And we're still positive when we look at the RSI, 14 as well as the 9 period. Going back to the early part of November, all of the readings continue to be above 50. So that's longer term positive. We came down to the moving average with on-balance volume. Since we had an update, we ticked up slightly above the moving average. We are turning up with the stocks in the S&P 500. Now, these are stocks inside of the index. Seeing a little bit of an improvement here with those that are above their 20-period moving average. This is the one that I've been really focusing on lately. This is stocks above their 50-period moving average. It had really dropped off after Friday. It did see some improvement in Monday's session. We're still looking really strong and showing good momentum in the longer term. These are stocks above their 100-period moving average. And we're still looking okay here with the 200-period moving average. The Copic curve is now turning more negative. It's dropping below its moving average. The Sean trend meter ticked up, but it's not necessarily, I said it declined earlier. It actually went up slightly, but it's not extreme right now. And the transports just continue to underperform the S&P. That is something we've been watching for quite a while and just not a real good thing for the market. Our different charts. Turning back a little bit more positive with the Heiken Ashi with an open candle. We're pointing back up with the Kegi chart. The Renko chart never did really freak out. It's continuing to be positive, and we're turning back more negative with the 3-line break. And we were able to get right back up to this blue trend line, just a little bit below that right now. And I have 2 trend lines here. I drew them from the October low, and for a while, we were holding up above this red trend line. And then we started to slow down. So then we came down below the red line. And then I drew another trend line below these lows that we were seeing here. We fell below that on Friday. We're just a little bit below it after our Monday session. And I had to readjust this again. I don't know what's up with this, but I adjusted this. And now it looks like the new cycle will start on March 20th. Here's the weekly chart. This is one of the ones I've really been focused on. This is the pivot points. These last for the whole month. We are still above this R1 level. That's at the 5110 to 5111 level. And with the up day, we cleared it a little bit. After Friday's session, we were like 6 points above this level. Now we're at 5149. Call it the 5150 level, the crazy level. So we are still above that. Now, if we drop below it, and especially close below it, that could turn things a little more negative. It seems like this 5150 level is becoming important to the market. Maybe they're just all Van Halen fans. And then we're still extreme positive with our 150 and 200 period simple moving average. And then we've switched back over with the NASDAQ 100 in the short term to positive, where the small caps are still negative. All of the other time frames on the other indexes are still positive. We saw a lot of green or blue, especially with the NASDAQ, and nothing really red happened in Monday's session. The equal weight still holding up fairly well for right now. We were up a little bit because Google had a good day. This pushed the ratio up slightly. And the Dow is still above this pivot point. So this support level is holding, but we're still negative with the diamonds when looking at the Elders Impulse system. And I've been watching this for the NASDAQ and the NASDAQ 100. We have an R1 level above, which is acting as resistance. We have a pivot point level below, and we're right in between the two right now on the NASDAQ. We came down to this pivot point with the NASDAQ 100 and then bounced up off of that. So far, this pivot point support is holding for right now. We switched from being negative over to neutral with the QQQs for the Elders Impulse system, but we're still negative when we look at the momentum for the NASDAQ 100. We were able to get back above and pretty much close right on the 20-period moving average for the QQQs. We lost that last week. To get that back is somewhat positive. With small caps, what can you say? We're just a little bit below the 50-period moving average with the S&P index, and we continue to be negative with the small caps when looking at the Elders Impulse system. We were also down with the Russell 2000 small caps, but we're still above the 50-period moving average. The momentum is negative. The longer-term trend is still positive, and we're dropping below 50 with the RSI. That's more negative. The mid caps are pretty much sideways. They were down slightly, and they've actually switched over to being negative with the Elders Impulse system when looking at the mid caps. Here's Google. Man, it came down to its 200-day moving average and started to bounce up off of that. It danced around the 50 period for a while, and then it gapped higher, and that really helped the market overall. Apple, though, still It was up, but it's still generating a recent death cross. And Tesla bounced up as well, but still is in a downtrend. The FANG index did show some improvement, but hasn't really broken out of this sideways range. The financial sector was up a little over 0.5%, continues to hold up fairly well. We were up with the dollar, so it's starting to rebound. That may have put some pressure on stocks as they were going down after hitting their highs earlier in the session. And then looking internationally, we're seeing the shorter term correlation show a little bit of an improvement here when we compare the S&P to the Morgan Stanley World Index. And this takes out the stocks in the US. So this is the S&P is the US, and then the rest of the world is this black line here that we're showing. And the longer term relationship is starting to get a little bit stronger again as well. We did continue to go up with the 10-year based on yield. That means that we were declining with the 10-year based on price. And then looking at growth to value, not a real improvement here. We turned up slightly, but the Qs are underperforming the S&P. Discretionary continues to be weak compared to the S&P. Large cap growth is underneath the moving average when compared to large cap value. We're a little bit below the moving average with the large caps, showing some weakness in the mid caps, and now the small caps are starting to drop below the moving average. But we're still looking okay here. This is a broad market measure of the 5-period moving averages of the highs minus the lows across the broad market. It is declining, but as long as we're above zero, it's still positive. We're also still extreme positive with our 10-day average of the S&P 500 highs minus the lows. So what's our outlook for Tuesday? We're still this is pretty much the same. We're still positive. There is weakness starting to come into the market. Even with the up day, we're still above this overhead resistance, and at some point we might see some weak seasonality. We're going to get housing starts and building permits in Tuesday's session. The thing about this is these are leading indicators because you have to get a building permit and think about starting to build a house before you actually build it. So this tends to look out going more forward, and then keeping an eye on all the craziness going on in the world that the market just doesn't really seem to be paying attention to. The big one is going to be Wednesday. This is when the FOMC will make their announcement. That'll be at 2 p.m. Eastern. And then I think it's about 30 minutes after that. That's when the press conference will happen. They have to give him time to run over to the camera so he can start talking. And here's another look at the big economic reports that will be coming out. Some of these I don't follow, like the crude oil inventories and some of these things like that. That's why I wanted to show this chart to give you a little different look. Seasonality, we are positive when we look at March 19th for the Dow, S&P, and NASDAQ. So we have that going for us from 2002 up to 2022. That's been holding up for the most part. And we're seeing a little bit of weakness here I have to find the green line. A little bit of weakness here during an election year with the green dashed line for the S&P. So we do see positive seasonality over the last 20 years or so. But when it's during an election year, we tend to see just a little bit of a downward move. And then we're wondering, are we going to go into this more of a decline as we continue to go out through the month of March? And this is also suggesting, even when the sitting president is running for re-election, that we might see some weakness as March plays itself out. Tuesday is not necessarily a positive day when we compare it to what happened in 2023. And we're coming out of this range now that Tom Bowley has found. The 18th was the last day there. Now we're coming into the 19th where, according to his research, we see some negativity. So our warning signs, and this is kind of in limbo right now. It seems like the S&P has been increasing in volume on down days. We have to take Friday off the table, though, because that was quadruple witching with a lot of options. We had an up day in Monday's session, but volume didn't increase. In fact, it decreased, and that's a little bit of a concern. The Copic curve is negative, and then we have our list of all these negative divergences that are going on right now. And we potentially could be entering some kind of a period of historical seasonal weakness. Positive. And I had to flash this one back over to the positive slide now. Our 5-period equity put call ratio is now going back down, and that is positive. The parabolic SCR for right now is still positive. The vortex is positive, but it has been showing some weakness. The NASDAQ 100 bullish percent index, it is now crossed back above 50. Small and mid cap growth continues to be positive, but it's been really chopping sideways For the small caps, it's still looking a little more positive for the mid caps. Large cap growth for right now seems to be holding up, and the financial sector is positive. So our conclusion, same thing that I concluded for Monday's session. We're positive, but we are showing some weakness. We're still above this overhead resistance, and we could come into a period of weak seasonality. That's what we're watching right now in the short term, especially if we see some more declines. We're going to be watching that 20-period moving average in the short term. In the intermediate term, we have a little longer list of those things that are overbought. If we fall below this overhead resistance, that could turn things more negative, but we're still positive for right now. And we're still looking positive in the long term, but we still have that 150 and 200 period moving average that is extreme positive. So thank you. I hope you have a really good day, and I will talk to you in the next video.